when I talk about 50-70% loss in the market, it's not so much a forecast, but it is an estimate of the level of decline that we estimate would be required to restore long-term S&P 500 expected returns on the order of 10%. And that's my concern here, is it's not a forecast that things have to go wrong. It's just a statement that things have to go right in order to get a pedestrian long-term return. And if they do go wrong, we have a lot of potential loss ahead. People back, who have followed me for a long time know I said the same thing, in March 2000 about tech stocks. If you looked at the valuations at the time, my comment, which I wrote in our monthly monthly letter, was that tech stocks would have to decline by about 83% in order to reach their historical valuation norms. And over the next 2 years, the NASDAQ 100 lost 83%. That's implausibly precise, but it turned out to be precise in that case. So I know these numbers sound preposterous. 50 to 70, is Hussman out of his mind? Unfortunately, history, suggests that that's not something that investors should rule out.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. There's an old saying on Wall Street that no one rings a bell at the market top. This is why so many surprised investors got so badly burned when the .com and 2008 stock bubbles burst. But those who noticed the extreme market conditions beforehand, whose analysis of history convinced them that defense was more prudent than fear of missing out, these few avoided most of the losses, and some even gained mightily from those crashes, having been positioned wisely in advance. Today's guest is one of those who smartly navigated the past two great market corrections. He now thinks we stand at the precipice of a third, and he's ringing a bell for anyone who'll listen. To hear why and what he advises we do about it, we've got the great fortune today to speak with Dr. John Hussman, founder of Hussman Strategic Advisors, economist, health scientist, and philanthropist. He also plays a pretty mean guitar. Now, John gives interviews very rarely, so it's a true privilege for Thoughtful Money that he's willing to give us the next hour of his time. John, thanks so much for joining us today.
It's always a pleasure to see you.
Hey, John, you're such a wonderful gentleman and a great scholar, and of course a highly respected market analyst and investor. I always just have to pinch myself when you come on. We're going to have a lot of fun today, but you've just issued what I would consider to be a very important warning or wake-up call for investors. So I'm going to forego my standard opening question because I think you've answered it in the commentary that you just released yesterday. So let me start just by reading a sentence or two from it, and then I'll let you go. Okay, here's what you said. You said, "I may as well just say it. Based on the present combination of extreme valuations, unfavorable and deteriorating market internals, and a rare preponderance of warning syndromes in weekly and now daily data, my impression is that the speculative market advance since 2009 ended last week. Barring a wholesale shift in the quality of market internals, which are quickly going the wrong way, any further highs from these levels are likely to be minimal. In contrast, current valuation extremes imply potential downside risk for the S&P 500 on the order of 50 to 70% over the completion of this cycle." So John, as I said, you rarely issue declarative warnings like this, but you have before. The article here that you published also includes several prior similar calls of market extremes that you made, including some warnings right before the .com and the GFC market crashes. So what's compelling you to do so again now? What's so important about last week?
So here's the thing. The idea of saying something like I said last week, the reason it starts with "I may as well just say it"
Mm-hmm.
is that I have a very high reluctance to say things that sound like forecasts. Our actual investment discipline is not about forecasting. It's not about calling tops or bottoms or anything like that. It's about aligning ourselves with observable market conditions and changing our investment position when those observable, measurable market conditions change. So the reason I published that piece this week is because when we look at market conditions, the thing that we always ask is, given these conditions, what are the typical outcomes? And usually there's what we would call a probability distribution. Some are positive, some are negative. We do position ourselves based on the average outcome per unit of risk. So for example, if you've got a whole set of different conditions, evaluations, the way that the market is behaving, whether it's overextended or compressed, these sorts of things, they'll all imply a certain skew to the distribution, either positive or negative. But there are some instances, and they're very rare, where we just don't find any positive outcomes or meaningfully positive outcomes, and very severe negative outcomes on the left tail, or vice versa. And so my market comment this week started with a whole series of those from past market peaks and market troughs all the way back to the early 90s. I've been doing this for 40 years, and I don't know that people have a good sense that we've done this at market extremes pretty regularly in terms of where we are. We should talk about this cycle. There's a second section in this, in my market comment, that specifically addresses our own stumble in QE, and there is no use in talking about what market conditions are now or what we did in prior cycles without at least addressing that. So we can do that at some point. But the main thing that we're seeing right now is this very rare combination of extreme valuations. And let me show you a chart of our best valuation measure. This is the ratio of non-financial market capitalization to non-financial gross value added, which is essentially corporate revenues. We include an estimate of foreign revenues. So we're really looking at an apples to apples sort of economy-wide price revenue ratio for non-financial companies. And that ratio is actually best correlated with subsequent 10 to 12 year S&P returns than any other measure that we've evaluated, including price to forward operating earnings, the Fed model, Shiller's CAPE, the Shiller Black Giraffe, excess CAPE yield, a variety of other measures. This has a better correlation. And so this is really what one of the main things that we look at in terms of valuations, but certainly not the only one. If you were to look at price to forward operating earnings, it's actually at levels that have historically been associated with very low single-digit subsequent 10-year returns. And if you look at the relationship between forward operating earnings, PEs, and the Shiller CAPE, you can see that the current level is as extreme, higher than it was in 1929 on that measure, and really in the highest levels of what we've seen in post-war data. So we don't just look at our own measures, but at this point, what we see is that we're at levels that exceed 1929, exceed 2000, and are higher than any other point other than about 5 weeks surrounding the 2022 top. What's interesting about the 2022 top is that the average stock, basically the equal weighted S&P 500 has actually lagged T-bills since that point. So has the Russell 2000. So really the only indexes that have done better than T-bills during this sort of extended top formation of what we think is the third great bubble in US financial history, are capitalization weighted indices like the S&P and the NASDAQ. And even those have only been ahead of Treasury bills for the last couple of months, since late April. So we've got extreme valuations, but then we look at something else, which is extreme valuations are not a timing tool, right? The only way to get to valuations like we see right now has been by blowing through every single level of lesser valuation. So the fact that valuations are rich does not tell you that they can't go higher. You, in fact, can't get to levels like this unless you go for years by blowing through those lesser extremes. So in addition to what we see on valuations, we look at in the intermediate term, essentially investor psychology. So the second piece of what we do is to ask the question, all right, well, we know that valuations aren't enough, but what distinguishes periods where stocks are overvalued and they continue to go higher versus stocks are overvalued and they kind of drop like a rock or somewhere in between, right? Well, that distinction is really driven by investor psychology. Are investors inclined to speculate, or are they risk averse? If they're inclined to speculate, then for a while, valuations tend not to matter. If they become risk averse, all of a sudden those valuations become very important, and you can have these what we call trapdoor situations where you have high valuations and people become risk averse. Now, how do you measure that kind of psychology? Part of it is, you can get a sense of whether psychology is extreme by looking at sentiment, but really when people are inclined to speculate, they tend to be indiscriminate about it. They don't just drive up small stocks, they drive up large stocks, they drive up utilities, they drive up tech stocks, they drive up mid caps, they drive up other security types like bonds and they narrow credit spreads and all these sorts of things, right? So when people are inclined to speculate, it tends to be relatively indiscriminate. And so what we try and do is gauge that uniformity. And it's different from just trend following. It's a different concept. But really what we're looking at is thousands of individual stocks, industries, sectors, security types, including debt securities of varying creditworthiness. So, we care about credit spreads between riskier bonds and safer bonds and that sort of thing. And really what we're trying to infer is a signal about either speculative willingness or risk aversion. And so that's what we use for our gauge of market internals. And while we can't rely on these gauges performing in the future the way they have the past, we introduced this to our methods way back in 1998 during the tech bubble. So this chart basically shows the cumulative performance of the S&P 500 in periods when our gauge of market internals has been favorable. And when it hasn't, you'll see this sort of like very, very mild slope upward. And that's basically treasury bill returns during periods where market internals aren't favorable. Clearly, the biggest losses happen when investors become risk averse. And the strongest gains are when they are inclined to speculate. So when we have a combination of extreme valuations and unfavorable internals, we have situations like 2000, 2002, 2007, 2009, even 2020, where the market basically, can often take a very large decline in a short period of time. Then the final piece of what we do, or at least the most important third piece, I should say, because we look at scores of other things as well. But one of the more important things is to look at very shorter horizons and ask the question, how overextended is the market? Now, I'm the son of two physicians, which is why I have this very weird scientific background as well. But my dad was a general practitioner. My mom was a pediatrician. I was supposed to be a physician, and I jumped the track. But I talk about things in terms of syndromes, because that's the way I learned from my parents, that when you're doing a diagnosis, for example, when my parents would do that, they wouldn't just look at one thing. The worst thing that a doctor ever encounters is a patient who has consulted Dr. Google and has decided that based on one symptom, they've got some horrible disease. And it doesn't work like that, right? What you have to look at is the holistic set of conditions and ask, how is this associated with particular outcomes? And so one of the things that we do is and I've been collecting and creating these for 4 decades now, we track a lot of different syndromes, as I call them, that try and gauge either overextension, especially where you've got overextension and sort of deteriorating market action underneath, or you have compression, where you have a sell-off that has really gotten compressed and certain measures of risk aversion have started to backtrack and come off, so that people are becoming just infinitesimally less risk averse, even though you've got a very compressed situation. And so we track these things, and occasionally we'll publish these special interim market comments when we see these syndromes. The last one that I published prior to a couple of weeks ago was in late November of 2021, when I published a piece called Motherlode. And it was basically because we saw this unbelievable preponderance of, or at least rare preponderance of, these really overextended conditions. And so when we look at, let's see, here's a tally of, for example, weekly, overextended conditions. And so we've got certain periods of time, for example, as we approach the 1973-74 top, as we approach the 1987 top, as we approach the 2000 top, 2007, there was actually one, that where we had a really high level of extremes in these kinds of syndromes in late 2018, which is hard to remember, but the market actually dropped almost 20% in the fourth quarter of 2018. And then, of course, we've seen this fresh preponderance of these syndromes in the past couple of weeks. And really what we're looking at is divergences in leadership, breadth, participation, credit, amid extremes in price movement and sentiment. So these are capturing, some of those characteristics. And then when we see those in weekly, as I talked about in our special update a couple of weeks ago, that's when we start looking at daily data. And I mentioned at the time that one of the main things we were looking at was deterioration in leadership, where you start to see lots of new lows, even though the market is hitting fresh highs. And so, for example, last week we saw, I think it was Monday, we saw this particular one. It's just one of, as I say, we have scores of these, but this was an interesting one that we saw, last Monday, which was the S&P 500 hit a 5-year high, but we had more stocks hitting new 52-week lows that same day than hit new highs, and we also had very muted bearish sentiment. Very simple syndrome, not an investment approach in and of itself. I would consider it sort of a weak signal in and of itself, certainly inadequate, because it doesn't identify enough of these, but it happens rarely enough that it suggests, and historically it's suggested, that there's something going on underneath. And when you see that kind of a daily syndrome, here's another one that I was looking for actually when I wrote the piece, I said, I talked about what we call a phase transition. And a phase transition is basically, if you think about physical matter, when particles turn from liquid to a solid, or from a solid to a liquid, or from a liquid to a gas, what you start seeing is groups of these particles start basically trying to decide which way to go, and they start clustering as if they're trying to make a decision. And then as you sort of get what is a phase transition from one state to another, it's as if lots of particles decide at the same time. And so you see this reversal. And the analogy to the stock market is when you start seeing, sort of shorter horizon volatility, even on 10-minute bars or something, and you've got extremes, and you've got lopsided sentiment, and then you start seeing this dispersion underneath, right? Where you're seeing, breadth is going the wrong way, price volume action is going the wrong way. It's not confirming things. You see more and more what technicians call non-confirmations. And then you see, so for example, Hindenburgs, they sound very scary. Hindenburgs in and of themselves happen a lot with no consequence. But in the context of a syndrome, when you're starting to see both new highs and new lows, exceeding 2.5% of traded issues, arbitrary but useful. When you start seeing, even though you've just hit a new high, new lows exceeding new highs, and you've had this very overextended condition, that's one of the ways that we try and put data around this, what economists call stylized fact of a phase transition. So what we're trying to do is we're trying to take data and say, all right, what is a syndrome that basically describes what we're looking at and what we're thinking about, and can we measure it in some way? And so we saw this kind of a phase transition last week. And again, these are things that are rare. They happen typically at market peaks, when the market is overextended and it starts breaking down internally, right? So 2000, 2007, early 2018, where we had a correction of about 14%, late 2018 again, 2019 fairly narrow, and then we had the 2020 decline in the first quarter, 2021, and we just saw that again. Single indicator, not perfect, not an investment strategy, not a forecast in itself. I can't say this enough, because when people hear, oh, Hussman called it top, it sounds as if I'm like, I just feel it. And it's not. What we're looking at is we're looking for a preponderance of data that basically says that what's normally a probability distribution has just gotten really skewed one way, right? And so this is the daily tally of these same things. And as you can see, we follow scores of them. But we saw some very strong daily tallies in 2000, again in 2007. You're right, again 2018, right before 2020, right before the 2022 January 2022 peak, and we just saw another one that last week. So it's this sort of idea. Valuations tell you about the long run. Market internals tell you about the intermediate term. Then you start looking for overextension, first weekly, then daily, and then kind of when it all comes together, things typically don't go well, right? And so from the standpoint of what do I want investors to take away from this, it's not that Hussman called the peak of this thing. It's not. What I want people to take away, the number one thing, examine your risk exposure. Make sure that you can tolerate the completion of a market cycle. If someone is a passive investor and they say they're a passive investor and they tell themselves they're a passive investor, but they've completely ruled out, for example, a market decline of more than 50%, or they've completely ruled out a period where stocks underperform T-bills for a decade or more, then they've not only decided to be a passive investor, they've decided to ignore history. Because basically, when you look at history, when we've gotten to points that are this far away from sort of historically normal valuations, stocks typically don't outperform treasury bills for long periods of time. So this chart here, do you see a sort of a line chart with some yellow bubbles on it? Okay, so what you're looking at here, the green line is basically what we would estimate the level of S&P 500 return, S&P 500 index would be associated with an average run-of-the-mill 10% annual return. Now, 10% is arbitrary, right? But it's kind of what people seem to have in their heads when they talk about long-term investing. 10% is kind of the historical average. Now, we're not saying that valuations have to get back to a level where they would be expected to, be followed by 10% returns. But the green line is basically our estimate. And one might think that, wow, that's preposterously low where we are. But, for example, if you look at the early 1990s, when we were in the early 1990s, if you look at the returns that the S&P 500 enjoyed over the next 25 years following the 1990 market low, it was 10.1%, right? So when we say stocks are fairly valued, as we did in 1990, or we say stocks are undervalued, as I did in late 2018, what we're basically saying is that on a historical basis, valuations are below levels that have typically, prevailed over time. And so expected returns are above levels that have typically prevailed over time. We can look at interest rates too, right? We can ask the question, well, where would valuations be? Where would the stock market be if we only required stocks to do as well as treasury bonds? And that line, for example, is this little dotted orange line. So the dotted orange line is the level that we would estimate would be associated with a zero risk premium, as they call it, relative to treasury bonds. We're well above that. But when we've been above that, and we've got some yellow circles here that basically identify those points, one of the things you can see with these brackets is that indeed stocks lag treasury bills for long periods of time. So, for example, from August 1929 to July 1950, stocks lagged bonds. From December 1968 to December 1987, stocks lagged bonds. From March 98 all the way to March 2000. People don't know this, but if you look at the data, you will find that stocks lag bonds. Same was true from April 2007 to March 2020. So here we are at very, very high levels, even relative to interest rates. And when people say, well, stocks are fairly valued relative to interest rates, it's important that investors know what's really being said. If interest rates are very low, what's really being said is, well, interest rates are low, therefore future stock returns can be low too. And sometimes they're assuming very, very low long-term stock returns. So you don't get to say, well, stocks are fairly valued relative to interest rates, and I expect stocks to earn 10% annually, unless interest rates are normal as well, right? So you have to be careful about how you talk about that. And the way that we prefer to talk about it is to use this sort of fixed benchmark, 10%, as sort of our valuation norm, and talk about historically normal run-of-the-mill valuations from there, and then use interest rates to vary that, right? So taking all those together, very long answer, but that's really what we've been looking at, and what was so distinct about last week, and distinct enough to write a piece that my hope is has the main function. Again, I do not have any intention to encourage passive investors to violate their discipline and abandon it, and or try and do this on the reg. But what I do have having been through multiple bubbles and feeling like I do that pretty well, on the crash side, is basically to ask the question, how much risk am I taking, and can I really tolerate the kinds of losses that have typically been associated with the unwinding of a bubble? And if I'm not, then how do I adjust my position in order, so that I maintain my discipline, but I use this opportunity, and I do it in a way that walks in advance and says, there will be regret. If I change my position, there's going to be regret. If I sell something, sell part of my position, and the market goes up, I'm going to regret having sold anything at all. If I sell something and the market goes down, I'll regret not having sold more. So the real key is choose your acceptable level of regret, right? And look at all the potential returns and the potential risks, and look at history and think about it. But if I do one thing, it should not, you don't walk away from this podcast with Adam and I, saying, oh, the one thing I took away is that we've got a top call. Wrong. The one thing I really want you to take away is look at your risk. Make sure that what you're doing in your portfolio really is aligned with the amount of risk that you can take over the horizon that you are investing.
All right, John. Well, look, you mentioned, you put this so well in your piece that I'd noted it, and you just mentioned it, which is advising today's investor to choose an acceptable level of regret, right? Nobody is going to, have a perfect investing track record, right? You're going to be a little early for your goals, or a little late, or sometimes a lot early, or sometimes a lot late. And so what you got to do is look at the current environment and say, given these conditions, what type of risk am I willing to take on here? If this looks like a very late stage cycle, and in your case, a very late stage of a massive bubble, do I want to be picking up nickels in front of the steamrollers to try to get those last couple of gains that might happen from here? Or would I rather go to defense and not worry if the market goes up a little bit more, because I'll regret getting caught exposed if I'm fully long when the correction happens, versus missing the last 2 to 5% or whatever it is, right? You're nodding as I'm saying this, but it reminds me of another phrase that you coined that I thought was so eloquent, which was that bubble markets force you to make a decision to look like an idiot now or look like an idiot later, right?
Yeah. It's and so really what it is to ask the question, how much risk is in the market. Someone shared a quote of Don Hayes with me, which is that valuations don't tell you when, but they do tell you how far. And so what we have seen in this particular bubble is a how far that went certainly beyond my expectations. So I actually do want to talk a little bit about this, because you can't talk about, for the average person, if they don't know that they actually know my name for what I did prior to this particular cycle, then all they know is how we did during this bubble, and that was actually too defensive. And there's a section in my market comment that talks about that, because I really want people to understand sort of how that happened. And the long and short of it is that after the global financial crisis, we did some stress testing. And one of the things that we found is that some of these overextended syndromes that we look at, when they occurred, if you were to say branch a tree and say, all right, what is the best first indicator that I would use to choose a branch of a tree between favorable outcomes and unfavorable outcomes? These overextended syndromes had such a strong and reliable record of that you always went down that one branch. And what happened during QE was that even when you got to these levels and these combinations of conditions that normally would have caused would have been followed by very, very steep market losses. Zero interest rates just encourage people to keep speculating, and that continued and continued and continued, and we ended up trying to adapt these ensemble methods that we implemented after the global financial crisis, and frankly, we had to abandon them in 2021. And so, what we are doing now is a whole lot more aligned and actually more flexible than what we were doing prior to this cycle. But it's important for investors to understand if they want to reconcile, wait, Hussman's really super flexible versus, Hussman's a perma bear. If you want to understand that, read that section of the market comment because it's important for people to understand that what quantitative easing and zero interest rates really did wasn't to change the structure of the economy. It was to create an investment condition in which somebody in the economy had to hold zero interest cash. If you have your cash and you don't want it and you want to, quote, put it into stocks, the person who you buy the stock from now has to hold that stuff. It doesn't go away. Cash doesn't go into the market. It goes through it. That's why it's called a stock exchange. Right? And so when interest rates were zero, people just had these 36% of GDP we got up to. Historically, it had never gone past about 12, 14%. We got 36% of GDP in zero interest cash from the Federal Reserve, and somebody had to hold it. Nobody wanted to, and it created this speculative bubble.
There was a hot potato factor. Whoever had the cash just said, I got to put it somewhere, right?
Yeah. Okay. And so if you walk through that, you'll get a sense of my own experience in this cycle, but also my hope is that what you'll take away is that by prioritizing internals, which have done beautifully even in this cycle, that's really what kind of restores our flexibility. Now, internals aren't favorable here. They actually haven't been favorable since 2021 because I actually suspect one of the reasons why is we're still at the borderline of recession. We still need more data to have that expectation with any confidence. But if you see what's going on, sort of underneath the labor market, that's really been the holdout. And what we had a very, very large number of job openings, following the pandemic. And we have gradually been working our way down. And normally you don't start seeing job losses until job openings, drop to about 4% of total jobs or less. We're getting there. And we're also starting to see an upturn in the unemployment rate. We're starting to see a pickup in new claims, which I would really watch. You should also watch continuing claims. There are lots of other things, help wanted. You're starting already to see a shift.
More notices, yeah.
Well, yeah, in full-time employment versus part-time employment, especially part-time, quote, for economic reasons, which means they're not part-time because they want to be. They're part-time because the work isn't available. And so as you're starting to see these shifts, we're getting closer and closer to, a period of risks. And the other thing that I will mention is the Fed eased the whole way down during the 2000-2002 market loss. It eased the whole way down during the global financial crisis. Right. Fed easing, when investors are risk averse, which again, we gauge through market internals, when people are risk averse, zero interest rate cash or low interest rate cash isn't an inferior asset. It's a desirable one. They want the cash. Creating more of it doesn't do anything, right? It's only when people's psychology shifts to speculation, for us, when market internals are favorable, that yes, Fed easing, can support things. Now,
Great
my
point.
belief in this cycle,
but you're saying that Fed easing is pushing on a string in those conditions, right?
When investors are risk averse, yes,
exactly.
When investors are inclined to be risk averse, because why, if you're risk avoidant and you think that the markets could lose value, right? You've allowed for the possibility that markets can lose value. Well, zero is better than the loss.
Just gonna say, you're
It's
happy to
only,
take the zero. Exactly.
yeah, it's only when you've ruled out the zero, when you've become speculative and you're basically saying, no, risk pays, right? When you have that mindset, which we got to during during QE, then yeah, Fed easing coupled with favorable market internals is very positive. The one difference for me that I have learned, and I will tell you, it was the hard way, is that even when you have overextended conditions, which historically put something of a limit on that speculation, once interest rates hit zero, that did not happen. And that was really difficult for us. And I say it up front because, again, the thing that, that if you're going to take away something where my work is useful to you, right, you have to be able to reconcile the fact that we killed it in prior cycles and we had some real problems in this one, and that we've adapted to that, and we've basically, abandoned the ensembles. But hopefully that puts it together.
If I can just ask this question, because I read that section, I think it's very important and very big of you to say, hey, look, here's what we got right, here's what we didn't get right. Is the kind of, as you said, the zero interest rates, I mean, the lowest interest rates in history, right? The massive interventions we had, it was a game changer. In many ways, it was like changing the gravitational constant, right? And all of a sudden, your physics equations aren't spitting out the same answers anymore, right? So you're like, I'm doing all the same things we used to do, but things are behaving the way they shouldn't, right? And it's largely because of that dynamic, I think. And then the other thing I think is notable about that is we're not in that environment anymore.
Right.
So all of a sudden, the old-fashioned Hussman approach, all the things that hey, we've seen all these. When we've seen this preponderance of evidence before, then X has happened. The likelihood of that, I think, probably goes up now that we're not in this weird, artificial environment anymore.
So yes, but two things. First is that even if the Fed goes back to zero interest rates, I think we'll do just fine. And the reason is, I think the adaptations that we've made, put us in that position, because what we don't do anymore, what we abandon is kind of that ensemble approach that we adopted after the global financial crisis. See, zero interest rates don't change arithmetic, right? They change psychology, but they don't change arithmetic. Okay. So if you look at a given set of cash flows and you pay a certain amount today for some future set of cash flows, the long-term return you get between here and there isn't theoretical. It's just math. It's just you can calculate that with a calculator, right? So zero interest rates didn't change the arithmetic surrounding market behavior. It did change the psychology. And so one of the things that we have, in what we are doing now is that we've prioritized market internals. So when you do have that, speculative impulse of investors, when they are inclined to speculate, right, we'll never take a bearish position, and 98% of the time we'll have a constructive one. Because we've prioritized internals in a way that in prior cycles you didn't have to. In prior cycles, once you got to those overextended extremes, the market would get hit, and that is the piece that didn't work, and that's the piece that we've kind of jettisoned. On the other hand, when you have unfavorable internals like we have now, when you have extreme valuations like we have now, when you have preponderance of overextended conditions like we have now, it looks a lot like 2000, 2007, 2020, right? It looks a lot like other periods. And so zero interest rates or not, I don't fear zero interest rates, right? I don't fear the Fed going back to, decades and decades of quantitative easing and Fed interventions and that sort of thing, because I think internals will pick that up, right? But what we will not be doing that we did, in hindsight for too long, was responding to these overextended conditions. The way that I described it in the piece last week or this week is, to believe that you could ignore those conditions, at least to me, was like believing that you could take a baseball bat to a hornet's nest and expect it to spew candy like a piñata. But the fact is that once interest rates hit zero, it was just candy. It was all candy all the time. And so we had to adapt,
All right. Well, look, sorry, it's a great analogy. The one that kicks into my mind, given your medical background, is, we have these hormones that tell us when to stop eating, when we're satiated and full. And, I think Ozempic and stuff like that, in some ways, they diminish our appetite, right? They give us more of that. Where this was almost like the Fed's ZERP and easing, to the extent of it, just removed that full satiation thing. And people just ate more than we ever thought a human could eat, right?
Yeah.
It's just like,
Yeah,
oh my God, this guy's stomach's gonna burst, right? But to your point about internals, and I think you might have a chart about this, and if so, feel free to bring it up. And just a reminder, I turned off the screen sharing, John. One thing I talk an awful lot about is the lag effect to policy and just to some of the distortion, a lot of the distortions and deformations that have been caused. And a lot of people have basically dismissed the lag effect this time around, right? Hey, we hiked interest rates, at the most aggressive pace that we probably ever have in history. Now we're holding them high, but nothing's happened, right? And so lag effect, it's different this time, right? Those famous words. You wrote in your piece that corporate profit margins surged in recent years, and that was driven. You do the analysis, which I'll let you go through, but the causal factor of that, if I read your piece right, was these abnormally low interest rates. And as I mentioned earlier, that era is now over, right? And so companies, I think, loaded up on cheap debt, and they've been able to survive so far. But now there's this wall of refinancing that's basically starting now, going through 2027, which is going to be, a reckoning that's going to have to be dealt with. How big a factor it is, TBD. But that's something that mathematically is going to happen from here, right?
So in this week's comment, I have a chart that basically talks about profit margins, because there is, I think, a widespread belief that the increase in profit margins in recent years and in the past couple of decades has been driven by, technological advancement and changes in the composition of, the S&P and, just all kinds of sort of new era features of the economy that just didn't exist before, right? And one of the things that we've done a lot of work in, not only in last week's piece, but there are multiple ones if you look back over this year, is we really look deeply into the nature of profit margins, and in particular, very large cap stocks versus the rest of the market. The fact is that even if you look at, for example, the profit margins of the largest 20% of the S&P in terms of market cap versus the median profit margin of S&P 500 companies, the ratio there has had no trend for 40 years. It certainly, the largest stocks certainly have some cyclicality to them, where their profit margins tend to rise more than most stocks at market, at economic peaks, and then retreat. And so you see a little bit of cyclicality, but you don't see a trend. So it's not the market composition or the technology that's really changing things. The other thing that's really interesting, and I've got a whole section on Schumpeter and the way that economies grow by entrepreneurial, factors. Basically, there is always a top layer to the economy that's very dynamic, very entrepreneurial. It's what's adding to, economic growth, but it's constantly shifting, right? Back in the day, it was automobiles, and then radio, and then computers, and the introduction of semiconductors, and then we've had all kinds of different industries come up over time. So even though every speculative period sort of decides that it's the new era, economic growth is actually just a whole cycle of new era after new era after new era going on. And yet, if you look at real GDP growth over the last 20 years, it's not just not higher than the prior 45, it's lower. So real GDP growth, real revenue growth for non-financial corporations has been lower in the past couple of decades than historically. So it is not the case that we're seeing all this technological revolution that people have in their heads driving this. We always have technological revolution. It is the mainstay of entrepreneurial growth. And what happens is companies create new products. They're initially very profitable, and they're initially scarce. And as that changes, the scarcity gets relieved and the profitability comes down, and they become a broader part of the economy. And then new technologies, new innovations take their place as the top sort of crust, the top surface of the entrepreneurial economy. That's just a fact, and it goes on and it goes on. But every speculative period sort of believes that it's the only new era that's ever happened. With respect to profit margins, if you look at real earnings or nominal earnings, I've made it real just so that we don't have inflation effects in this chart. But if you look at earnings before interest and taxes, and you look at profit margins of non-financial corporations, right? Medical companies, technology companies, retail, everything that's not, banks, right? If you look at earnings before interest and taxes, and you look at their profit margins before interest rates and taxes, well, guess what? Earnings before interest rates and taxes, non-financial profit margins without those expenses haven't changed in 75 years. What you see in this graph is the blue line is real earnings. The green line is essentially revenues, basically gross value added. And the two scales, because they are on two scales, are proportional. It's the multiple is 5 to 1. But basically what you see there is that earnings and revenues have basically gone up in tandem. There's not a huge variation in the ratio between them, which is another way of saying that profit margins before earnings, before interest and taxes really haven't changed much in 75 years. What's changed by definition is what is the only difference between that green line and that red line, which is, between that blue line and that red line, and that is interest and taxes. Now, what's interesting is that the effect of taxes actually had occurred, at least the impact on profit margins, had actually occurred by about 1981. If you look at tax payments as a share of corporate revenues, they've been trendless since 81. They've got a little bit of variation, but they've maintained a very flat profile. Even though statutory rates have gone down, in other words, the marginal rates, the rates that are quoted have gone down since then, the actual amount paid in taxes by corporations as a share of revenues hasn't changed. So the impact on profit margins hasn't changed. Most of that tax effect is before 1981. So what's left? Well, guess what? Interest rates. And interest rates have come down a lot since 1981. And they have, in fact, been the primary driver of non-financial corporate profit margin expansion over the last, over the last essentially 40 years. And so if you look at, for example, a scatter of S&P 500 operating profit margins versus the BAA corporate yield, one of the things you see is you see kind of a flatter slope between 1947 and 1981 in these blue dots. And the reason that slope is flatter is because you had less corporate debt as a ratio of revenues, right? So if you've got less debt, then the interest you're paying on that debt isn't hitting, your margins, as a ratio of your revenues. Those interest payments aren't hitting as hard. What we've done since, as Adam, you mentioned at the very beginning of this, talk, is that companies have loaded up on cheap debt over the last couple of decades, and so have governments, right? Which is we'll sort of talk about that another time. But one of the things that low interest rate policies have done is they've really encouraged an expansion of debt. The other adage that we talked about before we started this conversation is I forget who said it, but in a bull market, the way to riches is debt. In a bear market, the way to bankruptcy is debt, and nobody rings a bell, right? So when you expand debt, right, then interest rate effects have a greater impact. And what you see in these red dots is basically the S&P 500 operating margin versus the BAA corporate yield. And you can see that the slope has gotten steeper. And that's basically because corporations now hold more debt as a ratio of their revenues. And so interest costs bite down on their profit margins more. The reason we haven't seen that much since 2020, 2021 is because there was a massive wave of refinancing when interest rates were near zero. And we had record low, treasury bond yields and so forth. So we got a lot of those interest rates locked in. And as we go through the next few years, corporations are going to have to refinance. And so we will see more of these interest rate effects in a lagged sense, as you mentioned, coming through, as companies refinance.
All right, and that'll pinch profit margins, right?
And that would be expected to pinch profit margins. The other thing that's interesting is that if you think about the economy from the standpoint of sectors, you've got the government sector, you've got the private sector, you've also got the foreign sector, right? It's actually an accounting identity. And you can work out the math. And I've got some comments that prior comments that go through that, basically national income accounting. But the surplus, the deficit of one sector, right? Basically, their consumption, in excess, consumption and net investment in excess of their income, right? The deficit of one sector, it always shows up as the surplus of another sector. So when the government runs a massive deficit, it shows up somewhere else as a surplus. And the reason that is because if the government is buying stuff that it's getting stuff that it hasn't, that it hasn't funded through taxes or anything like that. Well, somebody's going to be giving up something, and they have to get something in return. And what they actually get is a government liability. So what happened during COVID, especially when we ran these $1 trillion deficits, is that we had large deficits on, the government side, right? But we also had large surpluses where companies and individuals produced more than they consumed, and so, well, if these companies are basically getting their production bought by the government or by individuals who have gotten government subsidies, right? They have to get something in return, and what they got is debt, and frankly, base money. So we've got trillions more dollars in government liabilities that are held, that were accumulated during COVID, because the government ran large deficits in order to stabilize the economy. But what that did is it showed up somewhere. And where it showed up is corporate profits. First, directly, because of, for example, PPP money, right?
Mm-hmm.
Where companies got subsidized for their employment costs. So even though they were running, part of their employment costs were paid by the government, so their profit margins expanded. And then there was a secondary effect where households accumulated these surpluses as well from COVID subsidies, right? And then they gradually have spent them down over the past couple of years. So you've had a bump to profit margins, not only because of low interest rates, but also because of this very, very high level of government deficit. And so, people have extrapolated these record profit margins without asking, where did they come from? Where did the spending come from? And the spending basically came because the deficit of one sector has to show up as a surplus of another sector. And so the deficits of government showed up as corporate surpluses and household surpluses. And then those households winnowed their surpluses down over the past few years, and those sustained the corporate surpluses. But that clock has kind of ran out as well.
All right. So, and we kind of got so many questions I'd love to ask you here, and we're getting a little tight on time. So
I'm running on. I realize.
No. You're just tossing out gold right and left, John. All right. So, some people will say, okay, consumer stimulus. I use the term "pig through the python." The pig is pretty much through the consumer python.
Yeah.
It's still passing through the corporate side. Congress does not seem to be, fiscal spending does not seem to be slowing down in real time yet. And so some people just say, well, why can't this just continue forever? So I'd love to hear any thoughts you might have on the dependability of the fiscal impulse here. But then let's get down to where the rubber meets the road, where, if I heard you correctly earlier, you said your look at the overall data leads you to think that odds of recession are non-trivial and growing. If a recession were to materialize, what impact do you think that's going to have on the picture?
So two pieces. One, talking about the fiscal side, right? There's this idea that, well, we just, if the government creates this liability, somebody will hold it and it's free. You can just print the stuff and create prosperity or stimulate the economy or whatever. The question is this: when somebody produces something and takes in return for it a government liability, right? Because that's what you're basically doing when you're deficit. Somebody's taking a piece of paper that says IOU on it, right? Why do they do that? They do that because they expect that somebody else is going to take that piece of paper for full value or nearly full value, and that person has to rely on somebody else taking that piece of paper for near value or full value, and that piece of paper and that piece of paper and that person and that person. There's this old question, Atlas holds up the world, but who holds up Atlas? Well, Atlas is standing on a turtle. Well, who holds up the turtle? Well, it's turtles all the way down, right? And so basically, the stability of the fiscal side relies on there being turtles all the way down. And that turtles all the way down idea relies on one thing, which is confidence, right? The reason it is so hard, and I promise you, if you stare at the data and you do analysis and you and you run, econometric models and all kinds of, very high level vector autoregressions, everything else, you will find that inflation is extraordinarily hard to predict. And the best indicator of inflation next year is inflation this year. And it is just a fact. It is extraordinarily hard to relate the level of inflation to things like the quantity of money or the rate of unemployment. If you look at the Phillips curve, actually you plot unemployment versus inflation and you do a scatter plot, choose whichever lag you want. It's birdshot.
There's
It
no
is
correlation.
not a curve, right? It's birdshot. So we've got these, models in our heads that we haven't necessarily checked against data. But the reason why inflation is so hard to predict is because so much of it is psychological. So much of it is based on confidence, right? And so if you get a situation where people have confidence, right, you can run deficits for long periods of time and people may maintain their confidence that, yes, this is money good, right? But if they lose that confidence, that's when you can see persistent inflation that then becomes uncontrollable inflation. And you see it in other economies too. Rudy Dornbush, who was an economist, once said, the crisis takes longer to arrive than you think it should, and then it unfolds much faster than you thought it would, right? And part of that has to do with psychology. When psychology shifts, that these things that are bubbling up underneath and building up underneath get released. That's why valuations alone, when people, I'm known for my valuation work. I'm very glad to be known for my valuation work. But what is a little frustrating sometimes is when people equate high valuations with a market prediction. Mm-hmm. And so we really have to be careful. When valuations are high and people are still inclined to speculate, there's a little bit of a balloon, we're just taking that and nothing's happening. Once psychology shifts, you get that shift. So that's, the first part of your question is, I don't think we can continue it on. We have to demonstrate some resolve. And really the goal of the Federal Reserve, quite frankly, is not to slow the economy down, or at least it shouldn't be. Right. The real goal of a monetary tightening in the face of inflation is to restore confidence, is to say we are not going to passively encourage deficit spending. We're going to make it more difficult so that we can maintain confidence. So it's that long-term confidence, not if you ask the question, how much does core inflation drop in the first 12 months of a recession? You know what the answer is? It doesn't, right? You got to look at the data, right? It just doesn't, right? So the idea that we're trying to control inflation by throwing ourselves in a recession is just contrary to the evidence, right? The reason you tighten monetary policy, and I think the Fed has done a good job, is basically because you have to, and that's a lot coming from me because I've been a huge critic of the Fed during zero interest rates. But they have to maintain confidence. I also think we're about at the level where the Fed may start cutting rates. I don't think that will be a good thing for the economy. Again, if investors are risk averse and you start seeing unemployment kick up and you start seeing economic weakness, the thing that you have to remember is that low interest rates do not change that economic dynamic very much. The decline in interest rates does, the Fed cut rates again through the global financial crisis, through the tech crash, and persistently and aggressively. So what matters is investor psychology, which we gauge with market internals. I'll say really quickly, if the Fed starts cutting and we see favorable internals, we're off to the races too.
Races.
We're good with that. We're fine with a constructive position in that case. But you have to be discerning that it's not just cutting rates that's going to do the job. In fact, the first cut in interest rates in 2000 was in September of that year, which was the beginning of the bear market. And see the same thing in 2007, 2009.
Yeah, what I'm really taking from you, John, is to see successfully. It's not a telescope; it's binoculars, and one lens is the math, and one lens is the mind, right?
And one more thing is that I'm a student of a wonderful Vietnamese Buddhist monk named Thich Nhat Hanh, and one of the things that he always says is life is found only in the present moment. The present, the past is gone. The future is not yet arrived. The future will be made of the present moment. And so one of the things that we try and do in our investment approach as well is not forecast, but identify. What are conditions right now? What do we see? Align ourselves with that. See those conditions change that we've evaluated, and that we have a strong belief that if we do this, we will do very well over time. If we believe that, then as conditions change, we align our positions and that sort of thing. We learn from our mistakes. We learn from our successes. We test everything. As I think that one's definite. We test everything. What we're trying to do is basically say, all right, what are the conditions right now, and what outcomes have historically come out? And it's usually a distribution. Right now, it's really skewed, and so it's a really good time for people to think about the kinds of risks that they're taking.
That they're taking on, yeah. And I just mentioned that because if one is just to look at your work, John, they see all the quantitative analysis you do and the massive amount of work quantitative work that you do. And I think they think, okay, this guy is Mr. Math, which you are. But you're also saying, look, you got to take sentiment into account, because you have different results with the same impetus or same triggers. They'll have different results if you have different environments of sentiment, right?
Yeah, I hate to disappoint you, but we quantify that too.
Not surprised. I'm not surprised at all.
No.
All right. So to the question about recession. So I guess, how worried are you if one materializes? Do you have a sense yet from the data you look at whether it will be garden variety or something bigger or worse? And what I guess if your bell ring is well timed and things do correct from here, I think earlier you said there's a potential. This is what valuations tell us, right? They don't tell us when, but they tell us how much it could be. There's a potential of like a 50 to 70% correction.
Yeah. So let me walk you through both of those, right? Because
just to be clear, that's not a prediction that John Hussman is making. He's just saying conditions are such.
Yes, thank you. I usually there's a word that you could probably look through my comments, and anytime you see me use the word emphatically, I use that word as a sort of a shorthand. And emphatically usually means emphatically, this is not a forecast, or emphatically nothing in our discipline relies on this. Emphatically, we are not blank, blank, blank. And the reason is because, again, we try to align ourselves with the present moment, right? And what we can observe there. With respect to recession, right? Again, one of the things that we know about employment is, so when I was at Stanford University, one of my dissertation advisors, and in fact, I taught his graduate macro class. I was his teaching assistant. Was Robert Hall, who was the chair of the National Bureau of Economic Research Business Cycle Dating Committee. And recession is always a syndrome. A recession is a decline in output. It's a decline in employment. It's a decline in sales. Basically consumption. It's a decline in across multiple areas of the economy, and there's some uniformity to it, and there's some extent and duration and depth to it, right? So 2 quarters of negative GDP is not how the NBER defines a recession. They define a recession in terms of this concerted decline in output, income, employment, production, right? And sales. And so basically what you're looking at is those features. Some of those have already turned down. Real retail sales have turned down and so forth. But gross domestic income, real gross domestic income has also been much weaker than GDP, gross domestic product, right? But the one thing that's really been the holdout has been employment. It's been unusual this cycle. And again, part of that has happened because we know that when there are lots of job openings, you don't see employment losses. When job openings are 5%, 6%, 7% of the total labor market, people have places to go, and so you don't see these large job losses. Once you start narrowing that out, that's where you start seeing that risk, and that's we're about a month or two maybe away from that possibility being realistic, that we could see job losses. The other thing we see is that if you look at the dispersion of unemployment rates across states, so again, we're big on noise reduction. We're big on taking a preponderance of data and finding the common signal. If you look at state unemployment rates, and ask, what proportion of them have already ticked up, 4 or 5, tenths of a percent, you see that really shifting to a level that you usually don't see except prior to recession. When you see, for example, the number of unemployed individuals, and Michael Kantrowitz it does some work here, and he's got his own indicator there. But once that goes above about 10% year over year, you've typically only been in periods that are either entering or right before a recession.
Right.
There are
We
various
above
SOM
10%
rules
now,
and this sort of
just
thing.
on that.
Yeah. And so there are various other rules that people look at how has the unemployment rate changed, and those are early indicators. And we have other ones that again have to do with full-time versus part-time, temporary employment versus part-time for economic reasons, and these sorts of things. And those are really where you're starting to see a shift, and those are the things that we would look at. Normally, we've also had a pretty simple four indicator recession warning composite. If the S&P is down versus 6 months earlier, if credit spreads have widened versus 6 months earlier, if the ISM Purchasing Managers Index goes below 50, and if you've got some increase in the unemployment rate, like the SOM rule was 0.4% off of the 12-month average or something like that. Once you start seeing these things, then you start actually saying, this is a risk, and we've identified that risk prior to other recessions too. Right now we're not there. We wouldn't require a huge amount of data to get there, but I think we are, my guess is we're likely to move in that direction, basically because we have been on a lot of stimulus for so long that the debt has built up and the income has not. And so household indebtedness is a problem, and so you're starting to see also credit card delinquencies and these other things, and so those are among the things that I'm watching. And again, I'm not at this point convinced that recession is imminent, but I think we're headed most likely in that direction. As to the extent of recessions, it's a little bit like inflation. It's hard to tell. It depends on how much confidence gets shaken, and that can have multiple factors. Buffett said, it's only when the tide goes out that you learn who's been swimming naked, right? And so you don't know. And so there can be blow-ups that change psychology, right? Lehman, right? Change psychology in a way that change what the outcome looks like. When we were writing about recession risk in 2007, my expectation was that we would have something more akin to a write-off recession, where debt would be written off, where you'd have credit strains, but it wouldn't necessarily expose the entire economy. And that's one of the reasons why, once things blew up and started looking like the Depression, well, we had never seen that in post-war data. Right. So that's what threw me into stress testing and ensembles that shot myself in the foot and this sort of thing. But the real important part for investors is you really can't make a forecast of how deep the recession is, but you do know that number one, the stock market tends to decline in advance of a recession. It's usually actually on a couple of months prior. And the drop in the market usually ends about 4 to 5 months before the recession ends. So it's when things look the worst that you're actually probably okay, especially once you see valuations compressed and a shift in internals, and we'll talk about that when that happens. But right now, my impression is that we're on the riskier side of the economic cycle.
Got it. Yeah. Well, I mean, so the title of your market comment there, ringing the bell, sounds like, what you're saying here through all of this, John, is hey, investors, this is a time to get real serious about risk, because there's a preponderance of syndromes and data sets and overvaluations and everything, along with your new model set that says,
well, the new model is over. It's actually kicking out what we introduced, and then it just tried to put band-aids on and then kicked back out. So we look a whole lot more like we did in prior cycles, I think.
Okay, but basically all that is saying the risk return ratio right now is heavily skewed to safety, right? And
at least the way that we estimate it, yeah.
Yeah. And so it wouldn't surprise you if indeed we had a pretty substantial market correction here, one that could get as big as 50 to 70%. That's not your prediction.
All right. So let's go back to this, these couple of charts, which are really deal with valuations. If you look at where we are in terms of valuations, clearly overextended. Then you ask, well, is this what kind of an indicator? Is it any good? And so this is in data since 1928. The relationship between our estimate of 12-year S&P 500 returns in excess of Treasury bonds, and then on the horizontal axis on the vertical axis is the actual subsequent 12-year returns. So this is basically the risk premium that you got over and above bonds over the next 12 years. And this to us is the strongest fit we find. It's actually the best equity risk premium model we have. But what's interesting about it is that the equity estimate here is nothing. It's nothing but a linear version of that. Of non-financial market cap to gross value added. All we do is take the logarithm of that, basically. And why logs? Well, if valuations are twice their historical norm, or valuations are half of their historical norm, they actually kind of mean the same thing, right? One is 100%, overvaluation. One is you would gain 100% to get to normal valuation. So logs actually clear up a lot of the weirdness in using multiples. But here, what you've got is basically, all right, well, our estimate is about negative 9.8%. Now we can fiddle with that a little bit, basically by saying, well, we expect interest rates to go back down to very low levels. So maybe we never get to historical valuation norms again, in which case we might have a little bit of a positive surprise. But even if you look at, the points on this chart that are the most off of the central tendency, it's only about 5-7%. So even in a case where future valuations remain at bubble levels, we really don't expect stocks to do very much better than bonds over the next 10-12 years. Right. So that's number one. This is why this is one of our most reliable measures. But also we can take that same measure and turn it into what this chart shows, which is, basically that green line is where our expected return estimate would land at 10%. That's the way that we think about that norm. Now, do we ever have to get to that level of expected return again? No. Have we generally? Yes. Have we always? No. So if you look, for example, at the 2000 bear market trough, we did not get to levels, at the October 2000 low that breached that green line. Unfortunately, we did 9 years later, or 7 years later at the 2009 lows. And during that period, stocks lost about, half of their value, even from 2000 all the way to 2009. So, so you can have these very long periods where valuations hover above historical norms and then come collapsing down. We certainly saw that in the Depression. We certainly saw that, in the 60s. And so we have been in this period of very, very elevated valuations. I would say that when I talk about 50-70% loss in the market, it's not so much a forecast, but it is an estimate of the level of decline that we estimate would be required to restore long-term S&P 500 expected returns on the order of 10%, basically on the order that people typically associate with stocks. Now, will investors be happy with 5 going forward from now until forever? If that's true, then, then stocks may not have to decline very much at all, because you figure, S&P 500 revenues have grown about 4% annually over the last couple of decades. You add a little more than 1% in dividends, and bang, you're at about 5, maybe 5.4% expected return if we maintain a permanently high plateau in valuations from now until forever. Now, that might be reasonable. You might say, well, 5.4 is fine. The problem is, if we ever get to a point where 5.4 isn't fine for investors, we're going to see much lower prices, and you will have basically bought a 5.4% expected return and find that investors later on demand a higher one. That's really what happened with bonds in 2000. You had bond yields, treasury bond yields, that got down to the lowest level in history, and people were like, well, bonds are fairly valued relative to interest rates, and they were by definition, right? And yet 30-year bonds lost half their value. Why? Because you buy a bond at a very, very, very low level of expected return, and when that when that bond yield goes up, the price has to go down in order to deliver a higher long-term rate of return. That's how British pension funds got really hit enough that the government had to step in, because when you lock in a very, 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 very low level of expected return, you now require everything to go right. And that's my concern here. Is it's not a forecast that things have to go wrong. It's just a statement that things have to go right in order to get a pedestrian long-term return. And if they do go wrong, we have a lot of potential loss ahead. And people back, who have followed me for a long time know I said the same thing, in March 2000 about tech stocks. If you looked at the valuations at the time, my comment, which I wrote in our monthly our monthly letter, was that tech stocks would have to decline by about 83% in order to reach their historical valuation norms. And over the next 2 years, the NASDAQ 100 lost 83%. That's implausibly precise, but it turned out to be precise in that case. So I know these numbers sound preposterous. 50 to 70, is Hussman out of his mind? Unfortunately, history, suggests that that's not something that investors should rule out. Not a prediction. But again, if you take anything away from this conversation, and Adam, I'm so glad you texted me yesterday and asked if we wanted to do this. I really do think it's an opportune time for investors to sort of evaluate their own risk preferences, how much risk tolerance they have, but do it in the context of actual historical experience and how markets behave over time, not just how they behave during a speculative bubble.
All right. Well, very well said. I'm so glad that you saw the text and had the availability and the interest to come on, John.
11 p.m.
Thank you. I know it's really
it.
late your time.
Yeah.
And look, the next question the viewer has, which I'm not going to ask you, is, well, all right, John, well, what assets do you think are appropriate for this type of market environment? The good news is we've got the financial advisors that Thoughtful Money endorses coming on right after you,
Beautiful.
who are much better folks to ask that to, because that's not the business that John is in. Although he does have to figure out how to navigate this for his own funds, but you don't give out individual investment advice.
Right,
so I want to
right.
get you off that hook. Yeah.
Yep. And actually, let me throw one little extra piece in here of history, that because I know that people do look at precious metals. One of the things that you will want to look at if you're interested in data is that all of the return of the XAU historically has occurred in periods where treasury bond yields have been falling, which sounds weird because you would think, wait, isn't gold an inflation hedge? Falling? But the answer is that what gold really responds to is compression in real interest rates. And so if you've got positive inflation or inflation is rising very quickly, or even modestly, and you have downward pressure on treasury yields, it also creates downward pressure on the US dollar, and it also creates upward pressure on gold prices. And that's usually the environment where gold stocks do best. They don't necessarily do badly all the time if interest rates are rising, but the likelihood is that the best times that you're going to have gold be precious metals be a really useful part of your portfolio. And we do this in one of our funds, with precious metals as being part of a bond portfolio, really, is when interest rates are in a downtrend. So just among the things that you think about, we really do encourage people to look at data, look at history, ask the question about, how are these things actually related in practice, not just in theory. John and Mike, I've always appreciated your work. So you guys have, a great perspective. So I appreciate that as well.
Well, thanks. When they come on, they're going to be just so honored that you just gave them a shout out there, John. Well, John, look, so for folks that have really enjoyed this conversation, wish it went on for another 3 or 4 hours, and would like to follow you and your work, where should they go?
Oh, just go to our website or follow me on Twitter.
All right, great. And John, when I edit this, I'll put up the URL to your website there and your Twitter handle. Folks, I'll also have the links in the description below this video too, so you can get there with one click. I'll also make the pinned comment John's market comment that he issued yesterday that we've been talking about this whole time. So you can go through the charts and read in depth all of John's commentary there. John, my friend, thank you. It's always a delight, incredibly enlightening, and really just an honor whenever you're able to come on the program here. Like I said in the intro, you don't give that many public interviews. It's just such a privilege that you're willing to do that here on this channel.
Adam, you know I love you, man. So I really appreciate coming on, talking with you, and that sort of thing. So very happy to join you guys.
Well, thank you. And the next time you come on, John, I do want to give a few minutes to your philanthropic work. I don't think people really fully have a picture on a full picture on that side of you and what you do, but you're involved in so many worthy causes, such a great supporter and funder, and at times when things really catch your heart and your interest, you bring your intellect to bear. I know on several health related causes, you've actually advanced the research. Like you've written white papers that have advanced medical understanding of some of these conditions.
Well, not just white paper. I mean, I've been published in Nature and Frontiers in Medicine and Frontiers in Pharmacology and European Journal of Human Genomics. So I've got this other very weird side of me that nobody would understand unless they knew that my parents are physicians and they were very, very serious about about encouraging an autodidact. One of the great joys of my childhood, which is so weird to say, was we used to have a book fair, and they would put up this massive tent, and my parents would send us in, and we would have a shopping cart, and you could just grab books. And one of the books that I actually quoted from from this in my market comment this week was like this book called Happiness is a Stock That Doubles in a Year, and it's it's got a dog bite from our dog Shotzi on it. And it's got this little picture that I apparently drew when I was like 10 or 12 years old, because I have no art skill, just basically I read books, and if you're a parent, as much as you can encourage your kids to just enjoy that passion and take them to the library and that sort of thing. That's I think a great thing in addition to getting them outside.
So John, just very well said. And look, I think you're a wonderful walking example of all of that. You might call it weird. I would call it extremely noble in terms of what you choose to do with that amazing autodidactic mind of yours. But anyways, thank you again for everything. Like I said, when you come back on the program in the future, we'll give a little bit more time to that side of you, because I think folks would really appreciate it. And it's just very important given what you're up to in the world.
Yeah, and I thank you for I know that I have I sometimes have like a 14-minute single sentence, but a lot to talk about, and I know that we chatted a little earlier about how much there was, so I appreciate being able to get together with you and talk about it all. It's a lot of fun.
All right, my friend. Well, look forward to seeing you hopefully in the flesh at some point soon.
Yep.
Pull out your guitar. Maybe we'll get a little workout in. Maybe even get you on the pickleball court. But John, thanks so much, my friend.
All right, thanks so much, Adam.
All right, well, that was pretty fantastic. Now is the point of the channel where we bring in the lead partners from New Harbor Financial. They're one of the financial advisory firms endorsed by Thoughtful Money. I'm joined as usual by lead partners John Lodra and Mike Preston. I'm going to let them react to John's brilliance there. And then if there's time, we'll talk about anything meaningful that's going on in the markets right now. John, why don't we start with you? Tour de force, I know, with one of your heroes. What's your reaction there?
Yeah, Adam, great privilege to be able to hear John share his views and comments so generally. Mike and I and our team have been voracious readers of his work and followers of his work. There's not too many things in life that we consider put down everything and run to whatever it is. His monthly commentaries are just one of those things, and he puts out great work. And I encourage folks, he shared a lot of the content of this latest commentary today in his comments with you, but there's so much more. He gets into a whole bunch of depth, and as great and as compelling as his graphs are, which are really heavily data researched, his writing is amazing. He in this day of 40-character tweets, I highly encourage folks to sit down with a cup of tea or whatever and dig through his writing, because it brings to life the charts in a way that the charts themselves can't, because it's full of nuance, it's full of context and humility. Frankly, that's one of the things that we like most about John. He's really disciplined and thorough in his work, but he brings a human and humility to the work that we think is real special. So really encourage folks to go back and read his stuff.
Yeah, he's just such a great guy. I mean, so brilliant, clearly a lightning in his brain kind of guy. And that makes, like, I got to say, videos like this are really challenging for me, because it's like, all right, Einstein has just stepped through a time portal and he's going to be here for an hour, and you can interview him and you got to figure out what of his entire body of knowledge, are you going to limit yourself to try to extract in just those 60 minutes, right? And of course, he had so much to say, more to say about almost everything I asked him. But again, just couldn't be a nicer guy, and a true polymath Renaissance man. As he sort of shared with us. But even that, when we met him in person, guys, and we spent time around a fire with him, listening to him play the guitar. I mean, this guy just has every talent under the sun. Mike, how about you?
It's a real honor to be on the same program with John. We've been a follower of John for probably since the housing crisis in 2008, and a couple things he said popped out at me. First of all, John gets criticized over the years for being early and for lack of performance in a giant bull market, and we understand why, because people are impatient. But look, we get criticized for being early too, and I'll fully admit that we were early, and we were wrong about just how different this particular time has been. Who really could have predicted TARP and QE1, 2, and 3, and all kinds of Operation Twist and stimulus? I mean, really, I guess we should have known when it started with cash for clunkers way back when. But there was stimmy checks and PPP and all kinds of things, and employee retention credit, and it goes on and on and on. And that's probably not going to stop. And I know that you had I think it was Thomas Honig on recently, former Fed president, that said, look, this is what they do. I think that it'll probably be more of the same in the future. I agree. And so John Hussman's pretty open about the misstep. And I'm not even sure it was a misstep, to be honest. I mean, who could have known? And he shows the charts of valuations, and they're way off the charts. And they've been way off the charts for the last 25 years. With only a couple forays to try to get to equilibrium. That chart, and I'd be happy to bring it up again if you want, but that chart with a green line on it that shows where the market would be to get 10% returns over time is really pretty powerful to me. And it shows in yellow some of the bubble periods that we've lived through. Since the late 90s, when the tech bubble had its zenith and then collapsed, there's been a couple attempts to get back to normal valuations, but the Fed hasn't let that happen. And so therefore, it's caused people that have perhaps known too much, or perhaps looked at the data, it's to be called, essentially to be called prudes, or to be too cautious. But I think it's pretty admirable that John Hussman admits this, and even, he stays pretty steadfast and humble, as we try to do during this time. I don't think that this time is different. I think that we see a change in the market. I think it's coming fast. I think it's coming this year, probably before the election. John Hussman just talked about ringing a bell. He said, ring my bell. And he's a very rare thing for him to do. Just one or two other things. He said, the markets have been delivering all candy. You whack the piñata or whack the bee's nest, I think he said. And instead of getting hornets, you get candy. It's not going to be that way forever. It's going to be hornets, and it's probably going to be that way soon. So again, a hero of ours. We talk about him often. We cite his data quite a bit. We do our best to incorporate some of his learnings in what we do. Obviously, we have our own customized way of doing things, but he's one of the people that we do listen to and we do read, and we would encourage people to do that. Don't tune out the data just because it hasn't mattered for so long.
Great point. All right, I'm going to have to keep our section here short just because John ran for so long. But so let's get to the okay. So what, right? So we just had this brilliant analyst John Hussman on. Again, great thinker, but rarely emerges to make a public proclamation, and decided to do so this week to say, hey, I'm ringing the bell because I'm concerned about all this stuff. So. You guys are in the business of helping just regular people, grow their wealth, but a huge part of that is protecting it, right? Is defending it against what John is saying. There's an uncomfortably high probability could happen, right? Some sort of big market correction that could be as big as 50 to 70%. Again, he's not necessarily calling for that, but saying the conditions are such it could be that big. Let's talk for a minute about how, what should the average investor be thinking in light of what John just mentioned here? And I'll cede your answer, and I'll come to you, John. I'll cede your answer by reminding folks that you and I, the two you and I, tomorrow are going to be recording a presentation from you guys on how to hedge your portfolio against market risk. So, listening to John Hussman, he very much seemed to say, hey, look, if you take nothing else from me, ask yourself, how much regret and what kind of regret are you willing to live with going from here? Are you willing to regret, getting defensive, and if the market continues to go up a bit, not participating in that, or do you want to put yourself at risk at trying to remain long, but perhaps eating, a pretty painful market decline if indeed the preponderance of syndromes he said he's seeing now actually come to bear, and we get a really big market correction. So, John, to the people watching this saying, hey, I kind of got a little spooked by what Hussman just said, what would you say to them?
Well, the first thing is to ground expectations in reality. And the way John Hussman does that is through data and really rigorous analysis of that data. As he pointed out very articulately, they're not in the business of predictions. They're in the business of observing situations, data, syndromes, and discerning from that historically what has this meant typically. Probabilities, right? That's very much the way we look at the world. Overlaying that to, we've used technical factors as well as, and up until fairly recently, this market from a technical standpoint was very, very, very bullish. And if you ignore valuations, one could say that one should have been fully invested in stocks just based on technicals, right? Over the last several weeks and months, we've seen things like breadth really start to deteriorate. Many of the dashboard things that we look at resemble many of the syndrome elements that John talked about as suddenly starting to flash concerns all at once. Now we're seeing a little bit of whipsaw in some of those indicators we follow. So, and they're not expected to go in one line. But I think he quoted the book. I forget the exact quote, but the basic idea was valuations don't tell you when, but they tell you how far. That's exactly the way we look at it. We know from history that the very large drops that can be absolutely, horrible for folks' financial security during retirement, for example, are the ones that emerge from hyper overvalued conditions like we have. So we like to, think that valuations set a barometer or kind of a limiter as to how much equity risk, for example, we're bound to take, even if technicals are very strong, because there is that probability of the elevator drops. So we use hedging tools, for example, to mitigate some of that downside. We simply will allocate. Right now, we're about 40% in equities with some hedges. But it all brings it back down to our clients and what their needs are. Very few of our clients have the need to stand up in a public corner and say, I beat the S&P. What they have a need is that their hard-earned retirement savings do well enough for them that they don't ever have to worry about running out of money, and that the ride along the way is as smooth as possible, because it gets into that psychological element that we talk about, the regret. Regret is another form of psychology, and there's going to be infinite opportunities for regret. You're either going to regret being too early, too soon, too uninvested, or not in the right things, or you're going to regret being too late. And by and large, the mathematical cost of being too late is way more damaging than being too early. That's what history will tell us. Bull markets rise very slowly, bear markets drop very suddenly. And that's many, many years can be wiped out in an instant. So a lot of gems there from John, and it very much resembles the kind of discipline that we take for clients.
Okay, and just a reminder that when the market does take the elevator down, right, when the bear market happens quickly, like you said, that's when people's emotions get inflamed. It's where you start to panic. It's generally where you make your absolute worst decisions as an investor because you're making them out of mindless fear in many cases. And so a good way to protect against that, obviously, is to be safely positioned beforehand. But even if not, you've thought through your battle plan where, okay, if this happens, then I'm going to do X, right? And you sort of pre-made your decisions. And so you just have a plan to execute versus having to figure it out on the fly when your emotions are raging. So again, these are all decisions that if you're a DIY investor, you should be doing all this pre-gaming now. If you're not, you should definitely be talking with your financial advisor, if you have one, or getting a good financial advisor if you don't have one, to be having these exact discussions, right? Okay, if this were to start to happen in the market, what are you, advisor, going to do with my plan to do with my money? And do I feel comfortable with that or not? So Mike, I'm going to hand the baton to you. I'll let you kind of close things up here. But yeah, on this topic about, constructive conversations that investors should be having right now, what else would you add?
Yeah, you're absolutely right. Emotion is the enemy, Adam, and having a plan ahead of time will keep you away from your emotions, which really is the enemy. And we're living during a time here where potential return on stock market investments is very low. John Hussman just showed how I think it's 12-year expected returns on the S&P are right around -5% a year. And that's every year. So it doesn't tell you about the path, doesn't say we're going to have a crash, but we could easily have a crash of 60 or 70% and then claw our way back up from there. Or it could be a slow grind sideways. Who knows? But there's not a lot of reward in the market, which is why we're at 40 or so % stocks. Now, for a lot of people, they shouldn't be in any stocks, in my opinion, if they're very risk averse, and particularly when you compare that to a 5.2% or so 6-month Treasury bill yield, or around 5% or so for 1 year. There's very good alternative. There is an alternative now. So for people that are really risk averse, that are really worried, you're not missing anything. Just sit and wait. Make sure you've got some gold and silver, 5 to 10%, and wait in Treasury bills. But we are able to go a little higher because we are trying to ride the wave a little bit, get a little bit of return, and because we have some advanced hedging tools like put options. We've got put options that we can use and call options and things like that will help us not get hurt or not get hurt very much on the turn. Nobody knows when that turn is going to come. I can guarantee you, and I should never say that word, I suppose, but I can almost guarantee you that it will come. None of us can predict it, and we can all admit that we're early. So, but it will come. And so I would take heed to the warnings that John Hussman talked about today. And the last thing I guess I'd say, Adam, is that gold and silver are in consolidation sideways ranges for 4 or 5 weeks. I expect them to go higher. Gold hasn't quite hit the target that we think it would or can. At 2,500, it's trading at around 23.20 right now. Silver is 29 or so. But we think gold will go to 2,500 and then silver up towards 34 to 35 when that happens. But the metals have been very volatile. You can take a look at copper too. That fell 15%, just like gold and silver did. But the base metals, we think will do well. Good time to think about owning or buying gold and silver if you don't have some already. Talk to us if you want to chat and get some advice.
And I'll just add, we may be a little bit conservative. Even Bank of America, a pretty mainstream firm, came out with their projection of 3,000 an ounce on gold. We're not in the business of predictions, but we do think it's a compelling buy right here.
All right. Yeah, as soon as Hussman started talking about gold, I was like, all right, I know the New Harbor guys are really going to want to dig into this. I promise I'll give you more time to dig into the precious metal side of the story next week, and we've got our regular schedule. Guys, thanks so much for dropping everything and joining me for today's discussion with Hussman. Look, folks, couple things. One, if you'd like to have John come back on this program in the future when he has another very important message to share with the world, please let him know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you haven't subscribed yet, please do, because we're getting very, very close to our 100,000 subscriber milestone on this YouTube channel. Would love your help in hitting it. Also, for everything that we talked about here, I talked about with Hussman, we've talked about here with John and Mike, this is the time to be doing your pre-game planning for the potential of a turn in the markets. And so if you've got a good financial advisor who takes into account all the issues that John Hussman and I talked about here, fantastic. Give them a call and have them walk you through their plan for you. But if you don't, you'd like a second opinion from an advisor who does take all that stuff very seriously into their data sets and into their strategy, might even be John and Mike here from New Harbor. Then consider scheduling a free consultation with one of the financial advisors that are endorsed by Thoughtful Money. To do that, just go to thoughtfulmoney.com, fill out the short form there, only takes you a couple of seconds. And these conversations that you set up are totally free. There's no commitment, there's no strings attached. It's just a public service that these guys offer to help as many people as possible, position as prudently as possible for what may lie ahead. John and Mike, again, thanks so much for dropping everything to join me today. It was a great discussion with Dr. Hussman there. Everybody else, thanks so much for watching.
Thanks for having us, Adam. See you soon.
Thanks, Adam. Real treat. We'll see you soon.